The guys over at Reddit Wall Street Bets are not looking for value stocks. And that is why they're so good at finding them. They are mainly concerned with big catalysts and companies with big growth opportunities. And when you start with a pool of companies that fit those criteria, and then you look for value, you've got yourself a badass investing strategy. Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. This is my YouTube public portfolio series where I invest in a different company every week. Before I get into this week's investment, I'm going to quickly go over the portfolio's performance so far. This is on M1 Finance. We've got a money-weighted rate of return of 6.19%. If you're not familiar with money-weighted rate of return, this just takes into account when you made the investment and how much it has made so far. So for instance, let's say a year ago, I invested $100 and it has doubled in value this year. And then I put another $1,000 into my portfolio. The money weighted rate of return would be much higher because even though I've got a balance of $1,200 and I put in $1,100, it would look like you'd have a return of just under 10%. But because you put the $1,000 in very recently, it's going to take into account that fact and give you a money weighted rate of return closer to 100% because the majority of those returns are from that $100 investment. Essentially, we're up $46.85. We're relatively flat, which is fine with me considering the market has been going down quite a bit. Let me pull up the S&P 500. We have been dipping. A lot of people are saying that there's going to be a market crash. And if we go back actually to when I started this account in December 26th, right here, the market is actually down since we started. So I'm happy with the performance so far. And that is why I'm investing in value stocks, because I'm looking for companies that are already undervalued. And when the market looks like it's overvalued in general and people are talking that like there could be a market crash, I like investing in companies that are undervalued, because if you're invested in a company that's overvalued and then we see a market crash, it's got a long way to fall just to reach fair value. And whenever there's a recession or if the market is in a downturn, people are often selling emotionally out of fear, and stocks in general have a habit of going undervalued. So not only do you fall from overvalued to fairly valued, you then fall from fairly to under. So I'm trying to find companies that are undervalued, not because they're bad companies. I'm trying to find companies that are overlooked by the market, that have strong financials, strong profitability, strong cash flow, but they are still trading below my projected intrinsic value. So we have Crocs and Hims that are both up quite a bit. Hims is really putting the portfolio on its back right now. And then BTI is also up slightly. Everything else is either slightly red or significantly red. Google is down 13% and ACAM is down 10%. So these are companies that I might look at a little bit closer in the future. If they're down a whole lot or up a whole lot, I might do a double check later on and see, like, do I want to adjust my holdings with these companies? But for now, I'm just looking at my new investment for this week. And the strategy I'm using is to look at Reddit Wall Street Bets. The way I like to use Wall Street Bets to find value companies is I like to filter by the different thread filters. So if I click right here, I can see there's no meme mode, DD, which stands for due diligence, discussion, charts, YOLO, etc. I like to filter by due diligence. This is where I tend to find the most serious research posts. So this is what I start with. Now, already there's quite a few recent posts that are getting a lot of traction. Just to quickly go down the list of the ones that caught my eye. mRNA, there's due diligence on that. There's due diligence on donuts, Krispy Kreme. We've got NEO, Chinese EV stock, Energy Transfer. This is a US energy company. And the one that I like the most for this week that I think has the best long-term prospects is healthcare, but not just healthcare in general. This is specifically home health and long-term care. Now, this guy right here, his name is Virtual Seaweed. I love this post by him. He gave lots of good research. So he's basically laying out where is the industry of home health and healthcare spending going. And he's also taking into account the age of the US population, which makes a huge difference. So this first graph, obviously we all know medical expenses have been going up every single year, but the big thing that's compounding with this industry is the age of the population. Because the baby boomers are not being replaced by the millennials and Gen X having as many kids, the percentage of the population that is old is going up and up and up. And they are going to need end-of-life care. They're going to need home health. They're going to need long-term care. And so this industry has a lot of big tailwinds coming up. This next graph right here shows the amount of people in the US population that are over the age of 70. This first bar chart shows just the number of people in millions But this second one down here shows the proportion. So in 2025, we've got 8%, but in 2040, 12% of the population is going to be over the age of 70. So this is a growing industry. Not only are healthcare prices going up, but the number of people who need this type of healthcare is also increasing dramatically. This graph shows the nursing care market, revenue in billions going up every single year, global long-term care market going up every single year. This is an industry that I'm interested in. So my next step, I like to leverage AI quite a bit in my investing strategy, using ChatGPT and using DeepSeek more recently, and Grok just make investing so much faster. It makes the research portion go much quicker. And the faster I can narrow down my long list of companies to a short list, the more companies I can evaluate and do a deeper dive. Now, this guy did give me 5 of the big names in the industry, but I like to start with a little bit of a longer list. So I go to ChatGPT and I say, give me a list of the top 10 publicly traded long-term care companies. And boom, it's got me my list. The next step is I want to take that list and figure out which ones have the best financial health. And for this, I'm using a tool that I haven't used yet on ChatGPT, which is the deep research tool right here. And I am really, really impressed. It did a very comprehensive research for me that saved me tons of time. So I said, please rank the top 5 companies in terms of financial health. That's pulling from that same list of the top 10 publicly traded. I said, take into account liquidity, solvency, operating efficiency, profitability, and free cash flow valuation. Because free cash flow, at the end of the day, that's what I like to pay attention to the most. This is the money that I see is being returned to shareholders. So companies that have the most free cash flow compared to their share price, that's what I'm looking for. It asked me a follow-up question. Before proceeding, could you specify if you have any preferred financial ratios or metrics? Or do you want me to just use the most commonly accepted metrics? Additionally, would you like a written analysis or just a ranked list? I said, use the most commonly accepted metrics and give me a written list. And after thinking for 4 minutes, it came up with 28 sources and the top 5 from that list of 10. Number 1 being Addus Home Care. Number 2, National Healthcare Corporation, LTC Properties, the Ensign Group, and HCA Healthcare Incorporated. So this is a great list. It gives me a breakdown for all of these. Every single one of these companies is relatively safe in terms of solvency and liquidity. Solvency being like for their short-term debts coming up, do they have enough cash to cover those? And how leveraged are they for the solvency? The only one that had a little bit of a red flag in terms of leverage, like having a lot of debt, was this last one right here, HCA Healthcare Incorporated, right here under the potential risks section. HCA's main financial risk is its heavy debt load. So if I quickly go through the risks of these, instance, slightly elevated leverage. So debt to equity is 1.1, not near as bad, or I shouldn't say bad, but not near as risky as HCA right here, there. Debt to equity is over 81. So this one really stands out as being a little bit more risky in terms of their debt, but that's something I can look at a little bit closer and see once I get into their financials, like, is it actually an issue? But potential red flag. For LTC, a weak spot is its interest coverage. So their interest payments are relatively large compared to how much money they're taking in every year. So that is a little bit of a red flag. National Healthcare Corporation, given its minimal use of leverage, so very little debt, their growth and returns are somewhat lower. So I do like to see growth. That's not too good there. And then potential risks of Addus, their margins and their returns are solid, but they're middle of the road, but everything else is really safe. So these top 2 companies, they seem to be very safe in terms of their financial health, but maybe their valuation and their profitability could be lagging a little bit behind. And maybe I'll be willing to take the risk on one of these other companies that has higher leverage. If you're already familiar with my channel, then you know the next step that I like to take is to use my discounted future free cash flow spreadsheet, which is automated. All I have to do is put in the ticker and it automatically pulls all the information off of stockanalysis.com and calculate. It makes all the calculations. It just makes my job a lot easier. It automatically makes some graphs for me to get a quick look at the company and how it's doing. One weakness with this spreadsheet and using stockanalysis.com is sometimes stock analysis has different names of things. So like instead of revenue, they might call it total revenue, things like that, which is really frustrating. It only happens about 5% of the time in my experience. Unfortunately, it's happening right now with LTC. As you can see, this is the information that's being pulled from the internet, and it just has lots of gaps in it. They call it total revenue instead of revenue. They don't have gross profit or gross margin. So I'm not going to be doing this company. I'm only going to be doing the other 4 just because I really don't want to go through and enter in a bunch of data manually. I like this to go quickly and conveniently. There are some gaps for NHC and ADUS, but that's okay. Since that's just a few gaps, I'll manually enter in just that little bit of information so we can move forward. Back to the spreadsheet. So all I do is I type in the ticker right here. It automatically calculates free cash flow. However, I do need to add the analyst projections. So I go to stockanalysis.com, go to the forecast. So Addus Home Care Corporation is currently trading at $95.77. They do not have a dividend. To the revenue growth, this is how I do my calculation. So I take the projected revenue growth, I look at the historical free cash flow margin. Sometimes I'll make some adjustments to the free cash flow margin. That way I can project the future free cash flow using analyst revenue projections. Just copy this data and put it into my spreadsheet. And while I'm looking at it, the analysts look like they are pretty confident with this company, especially in 2025. The lowest analyst projections are showing 18% revenue growth, whereas the highest are showing 35.4. So right off the bat, that looks pretty good. Let me go to my spreadsheet and I'll copy this in. Okay, now they only projected 2025, 26, 27. I'm just going to go with these values right here for 2028 and 2029. And actually, I will adjust these right here. I'll say 2% and 2% because that is the low projection. With that in mind, the analyst's low projection is now $139 per share, while the current share price is sitting at $95. So that looks pretty good. Their past free cash flow margin is 9.33. So now the question is, do I need to adjust that free cash flow margin? So what I like to do is I like to look at their capital expenditures and their acquisitions and their stock compensation. So the way free cash flow works is they take their cash flow from operations and they subtract capital expenditures. Depending on the type of the company, capital expenditures could be a recurring expense for the most part, or it could be money that goes towards growing the company. If the capital expenditures is more associated with growth, then I'm not going to subtract out as much from the free cash flow, because the thing that I'm really trying to hone in on with free cash flow is how much money is being returned to shareholders. And if that money is being spent for growth, then I really don't want to subtract it out of the free cash flow. So in this case, the majority of this capital expenditures is going to be towards growth. So if I go to their annual report here, I can see a little bit of their breakdown. Acquisition of businesses, net of cash acquired. This is $354 million, whereas their purchases of property, plant, and equipment, this is going to be buying new furniture, updating their current properties. This is going to be more of the money that's going to be recurring expenses. And I can see this is $6 million, $9 million, $8 million. It's relatively low, whereas their acquisition of businesses is the majority of the cash there. So they actually show the 354 in the other investing activities. They're not taking it out of the free cash flow. However, I'm still going to take a portion of that money out of the free cash flow, because whenever you buy property, plants, and equipment, you're going to have more recurring property, plant, and equipment costs. And whenever you do cash acquisitions, generally the company that's purchasing is paying a bit of a premium. So I like to take out some of that money and not give credit for the full 354 million. So the way I'm going to handle that is on my spreadsheet. I'm going to take away 10% of that 354 million. And the result is their average free cash flow is now 8%. So I got to go back up to the top. I'm removing 1.3% from their free cash flow margin. And now the analyst low projection is 118 and my projection is 108. If I go with my projection, that's assuming 3% growth over the next 5 years, 3% growth for the 5 years after that, and then 3% growth going forward into infinity. If I make that assumption, then my projection is $108 per share. That gives me an upside of 12.86%. So that's what I'm looking at for this company. And I think 3% growth is very conservative, considering there's going to be more and more old people and the cost of healthcare is going up. So this is going to be my benchmark. I'm also taking into account the analyst projections to see what my potential upside is. So in this case, with the analyst high projection, we're looking at a big upside of 100%, and the average analyst projection is 159. So that's about 60, 70%. So the upside is still really solid for this company, but I'm going to say it's 12.86% undervalued. The next company I want to look at is NHC, oops, not NHX, NHC. Now, the problem with this company is whenever I go to stockanalysis.com, there is no section for forecast. So there are not any analysts on here that are projecting the future growth of this company, which is always a little bit of a red flag for me. So I'll be taking that into account. I'll be a little bit more conservative with my estimate for this company. Now, I've already gone through and put in all the information. This one was lacking a few pieces, so I manually entered in the capital expenditures and the acquisitions for 2024. Once again, I am deducting 10% from their free cash flow for their acquisitions, and I'm giving them credit for 25% of their capital expenditures. This makes their new free cash flow margin 8%, which their past free cash flow margin over the last 5 years has been about 6.5%. So I'm going to give them credit for an additional 1.5%. Additionally, if I want to go and look at their trend for their free cash flow margin, I can go to their income statement on their financials document and see the free cash flow right here. So they have been growing their free cash flow year over year. Their free cash flow margin has been a little bit lumpy. 8% seems a little bit high because this number right here is really bringing up their average. They had a really good year, 18.55%. So I actually don't think I'm going to give them credit for much more free cash flow margin. And because this company doesn't have analysts projecting their future growth, I'm going to be a little bit more conservative and just keep that at 0. So with that in mind, my projection, assuming 3% growth going forward, that puts their share price at $119. Their current share price is $93.17. That gives me an upside of 27.88%. However, this company seems a little bit risky to me because there's not analyst projections. Next up, ENSG. Now with this company, even though I gave them a 2% boost this time to their free cash flow margin, my projection is at $116 a share. However, they are currently trading at $130 per share. So this company is clearly not valued as well as ADUS and NHC. Both have significantly higher upside. So I can eliminate the Ensign Group. They're just not trading at the discount that I'm looking for. Their future revenue growth does look pretty good, but once again, it's just, even with that growth factored in, they're currently not undervalued according to my future free cash flow analysis. So let's go ahead and move on to the last company, which is HCA Healthcare Incorporated. They're trading at $306 per share. Let's go ahead and put that in. HCA was overvalued. Okay, so for HCA, let's cancel this out. I don't know if I'm going to give them credit for any free cash flow yet. Assuming 3% growth, my projection is $333 so far, so that looks really good. That would be about 10% upside right off the bat. Now, one thing that jumps out at me is their shares outstanding. This is the only company where they have been doing consistent share buybacks. Right here, this blue line shows their number of shares outstanding in millions. The red line shows the percentage that it has dropped. So in 2021, they bought back 4% of their shares. 2022, they bought back 10%, 6%, and 5%. That is really good. So they are spending a lot of their free cash flow on share buybacks. Now, do they have a dividend on top of that? Let me check really quick. They do have a very small dividend, about 1%. So that's really interesting. And I can see that if I go to the financials and go to ratios, it shows me the dividend yield, which is 1%, and it shows me the buyback yield, which is 5.28%. So one way to look at this is I could add together those two yields, and that kind of represents the total dividend yield that you might see with some companies, except a buyback yield is nice because you're not having to pay taxes whenever a company does share buybacks, like you do have to pay taxes when they do dividends. According to their R&D, their capital expenditures, and their acquisitions, this is saying that I could be giving them credit for a 12% free cash flow margin. So why is that? This company, they have quite a bit more money spent on capital expenditures. Oh, actually, I need to adjust the spreadsheet because I'm no longer entering in data. I need to use my formulas once again. This company actually has quite a bit of capital expenditures compared to the other companies and lower on the cash acquisitions. Currently, I'm giving them credit for 75% of their capital expenditures. So I want to check and see, is that reasonable? Do I think that they're really spending 75% of this on acquiring more properties for growing their revenue year over year? Or is this going to be upkeep expenses largely? So one way I can make that determination is I can go to their financials, go to their balance sheet and see what is their property, plant, and equipment, and how much is it going up year over year. This is a little bit tricky because this does account for depreciation and amortization, but I'm seeing their property, plant, and equipment going up every single year. And in terms of a percentage, currently they have in 2024, 31 billion in total on property, plant, and equipment. If I go to the amount that they spent on capital expenditures, that is about 10% of their property, plant, and equipment. Given that ratio, I don't know if I want to give them them much credit, actually. I think 75% is a little high. It could be the case that the majority of this is actually spent on upkeep, considering it's only about 10% of their total property, plant, and equipment. I'm actually only going to give them credit for 25% instead of 75. So that brings their new free cash flow margin to 10% on the dot. So going up here, that means I give it a boost of 1.3 to bring them in line with 10%. Now my projection is $409 per share. Their current share price is 306. So it gives a current upside of 33.57%. And that's for my projection if their annualized revenue growth is 3% going forward for the next 10 years and then on after that. So this company has the biggest upside in terms of what is their free cash flow doing compared to their share price. They also spend a lot of money on share buybacks, which I really, really like. So the red flag, if I remember properly, the red flag that this company had was they had a lot of debt. Looking at the company's balance sheet, I see they have $2 billion in cash and short-term equivalents, and they have $16 billion in total current assets. So this is the pool of money that gets used for paying their short-term debts in the next 12 months. If I look at their current liabilities, I see it's at $15 billion. So they do have enough cash if you include their inventory to cover their upcoming debt payments. Another thing to consider is when I go to their cash flow, they do also have $10 billion in operating cash flow, and that has been consistently going up year over year. With the exception of these 2 years, their operating cash flow looks very consistent, very good. Their operating margin is consistently about 15%. So that gives me confidence that they're able to cover their short-term liabilities. Now, as far as their long-term liabilities, ChatGPT said this company is very leveraged. And leverage was one of the things that ChatGPT pointed out in its deep analysis. That was a red flag for this company. So if I go to their balance sheet really quick, I can see that yes, they have big time liabilities. Their total liabilities, $59 billion. Their total assets, $59 billion. The shareholder equity, like the amount of ownership that you actually have as a shareholder in terms of like physical assets after the company pays all its debts, very low, only $555 million. And the company's market cap is $76 billion. So when you buy a share, you're buying a share of $76 billion, but if they had to liquidate, there's only $555 million. So the question is this company at risk of going out of business? If they were to go out of business, that would be catastrophic because they have so much debt. And if their interest expense was an issue, that's another thing to look for. Looking at their interest expense, it has been growing every year. It's at $2 billion. However, their operating cash flow is $10 billion. So they have plenty of cash flow to cover their interest. They've got plenty of cash on hand to cover their upcoming liabilities. So I think this company is worth the risk, especially considering they're in an industry that is going to be having massive tailwinds going forward into 2040. The percentage of old people in the US is only going to increase. The cost of healthcare is only going to increase. This is a great company to buy. This is the one I'm buying for this week in my public YouTube portfolio series. If you like this kind of analysis, check out the most recent video in this series right here. I'll see you there. Cheers. Oh, that is a good one. Colonel E.H. Taylor. Super good. Where's the kitties? Lily? Momo?